Drawings. Drawings means any asset taken by the owner or proprietor of the business for personal use. If the owner take anything, whether it's cash or goods or any asset for personal use, that will be called drawings. And drawings always reduces the capital and they also reduces the asset. If the proprietor has taken cash for personal use from the shop, that will be drawings in cash. On one side, capital will be reduced. On another side, cash will be reduced. Suppose someone is running bookshop and for his personal use, maybe for his younger brother, he takes the books from the shop and give it to his brother. So that will be drawings, but in the form of goods. For example, suppose there is some old furniture in the shop and the owner feels that it cannot be used any longer in the business or shop. So he takes the furniture to his home. It means he has taken furniture from the shop for his personal use. That will also be drawings. So drawings can be in any form. That may be cash, that may be goods, that may be any other asset. So be careful. Drawings has double effect. Number on one side it will reduce the capital, and number two, it will reduce the asset. That asset may be cash, may be goods, may be any other asset. So I would like to remind you one thing. The capital gets reduced only for two reasons. Either drawings or second, loss or expenses, you can say. So let's take one practical question. A starts business with cash, rupees 5,000. Transaction number 2, purchased goods, rupees 1,000. Transaction number 3, sold goods to C, costing rupees 800, for rupees 3,000. Transaction number 4, cash taken for private use, rupees 300. Transaction number 5, goods taken for private use, rupees 100. And closing stock as on 31st March 2013, rupees 100. So let's do the accounting equation on the basis of all these transactions. A starts business with cash rupees 5,000. It means the firm is going to receive cash from the owner. So it will increase the cash by rupees 5,000 and the capital will be increased by rupees 5,000. So on capital column 5,000, cash column 5,000. Purchased goods rupees 1,000. It means cash purchases. So it has nothing to do with the capital. Cash will be reduced by rupees 1,000 and stock will be increased by rupees 1,000. So new equation will be capital 5,000, cash 4,000 and stock 1,000. Sold goods to C, costing rupees 800, for rupees 3,000. It means the firm has made a profit of rupees 2,200. So it will be a plus item in the capital column 2,200, in the cash column plus 3,000 and in the stock column minus 800. So new equation will be 7,200, cash 7,000, stock 200. Then cash taken for private use rupees 300. Naturally, these are the drawings in cash for rupees 300. Drawings always reduce the capital. So in the capital column minus 300 and in the cash column minus 300. Stock 0. So the new equation will be capital 6,900, cash 6,700, stock 200 rupees. Next transaction, goods taken for private use rupees 100. These are also drawings, but these are drawings in goods. Drawings always reduce the capital. So in the capital column minus 100, cash column 0, in the stock column minus 100. So capital will be 6,800, I mean to say new capital. Cash will be 6,700, stock will be rupees 100. So this is the last equation. Let's make balance sheet on the basis of last equation. So balance sheet as on 31st March 2013. Capital 6,800, cash 6,700, stock 100, and the total 6,800 on both sides. Now let's calculate the profit earned by the firm. You know, profit is always equal to closing capital minus opening capital plus drawings minus fresh capital. So closing capital is 6,800 minus opening capital, that is 5,000, plus drawings 400. You know, the proprietor or the owner has taken 300 cash and 100 goods. So total drawings are rupees 400. So plus 400 minus fresh capital, that is 0. So that is equal to 2,200. It means this firm has made a profit of rupees 2,200 during this year.